Thank you again for joining us. Welcome everyone to Roth Conversions, Unlocking Tax-Free Growth Potential. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. I briefly want to introduce our speaker today, Brad Sininsky. He is a solo 401k and SDRA consultant here at Sense Financial. He has a professional journey over 18 years in real estate investing, is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Thank you again for joining us today, Brett, and I'll let you take it from here.
All right. Yes. Thank you, Leah. And thank you, everybody, for taking time out of your day to join us today. This will be recorded. This will go out automatically if you registered for it. Otherwise, you'll be able to find this recording on our YouTube channel as well as our website. So Roth conversions, we're going to talk about unlocking tax-free growth potential. And really what this is are strategies for creating lifetime tax-free ATM withdrawals. That is our goal here today. Okay, so let me make sure that I can, there we go. All right, so that's my info, my email and my direct number. You can call or text or email me directly if you'd like. We are not here to provide financial or legal advice. If you need such advice, such as what is my tax liability going to look like if I do a Roth conversion, you should talk to a tax professional. This is educational only. I want to be able to provide insight for you to take and chew on, and then talk to the proper professionals and make an informed decision. So that's our goal here today, along with this agenda. First of all, we're going to talk briefly about the difference between a traditional type of retirement account and a Roth retirement account. We're going to talk about what is a Roth conversion and the different methods that you can use or employ to convert from traditional to Roth, whether it be an IRA or 1K. And then a few actually two specific investment examples where people did what's called an in-kind Roth conversion at a discount. You're going to love that part. That's probably my favorite part about this whole strategy. So, whoops, why is that in there twice? That is so weird. Hold on. Okay. So first of all, what is a traditional versus a Roth IRA? Well, the question you have to ask yourself when considering a Roth versus traditional and what to focus on is, do I want to pay taxes on the seed or do I want to pay taxes on the harvest? And obviously, if all goes as planned, the harvest is much larger than the seed, right? Hence the different pictures there. And you can see in the Roth IRA side, you're just planting these little tiny seeds, right? Maybe $7,000 a year. But over the course of time, that grows to be a great harvest. And when you do harvest, which means taking a distribution, whether it be at retirement or not, we'll talk about that, is going to be a lot larger than the initial contribution. So the conversion is taking it from the traditional side to the Roth IRA side. So here's a quick example of what a traditional versus a Roth IRA looks like, as well as a taxable account. Okay, so this assumes a 12% annual return, a 30% tax rate for contributions, and a 20% tax rate for distributions. And understand that in 1973, when traditional IRAs first became a thing, before 401ks, before Roth, the idea was that you are partnering with the IRS, right? In the sense of they will give you a tax deduction for making a traditional contribution, right? I contribute $7,000 this year, or $6,000, and I'm reducing my taxable income by $6,000. However, the IRS allows it to grow tax deferred because when I take a distribution, that money is being added to my earned income in the year I take the distribution, whatever it is. And the idea behind this was my tax liability during my earning years is going to be higher than my tax liability during my retirement years, which may or may not be the case, right? That's why the assumption here is 30% while you're working, 20% while you're retired at distributions. So here's the difference. A taxable account, right? This is after-tax money. This is just your money, personal money. I throw it into a taxable brokerage account as an example, or invest in real estate or whatever, but let's just use a taxable brokerage account for simplicity. I'm investing in the S&P 500. I'm getting a 12% annual return. Okay. At the end of 25 years, at an annual contribution of $6,000, taxable account will be worth about $602,000. In a traditional IRA retirement account, I'm getting these tax-deferred contributions, I'm making tax-deferred contributions. My account's going to be worth about $894,000. Now, move over to the Roth side, and my tax-free or Roth account is going to be worth $1.1 million. Now, this is because of the accounting for the tax rate at distributions, okay, when you take distributions. So the difference here is massive, as you can see. It's actually about $516,000 of total tax savings when you look at taxable versus tax-free. Again, all the assumptions on the left are what's factoring into this. 25 years, you're making contributions of $6,000 at $16.43 per day. Okay. So that's what that is. So it's massive. I just want you to understand the implication here when you're considering, okay, seed or harvest. All right. Your future self will thank you for incurring the taxes today instead of later. I promise you. All right. So what is a Roth conversion? Well, a Roth conversion is this. First of all, you can convert a portion of your entire traditional IRA, or you can convert the entire thing. You can do multiple conversions throughout a single tax year. You can do some this year, some next year. Your deadline to convert for a tax year is the calendar. It's December 30th, and I'll explain why that's relevant. And then there's no need to withhold for taxes. You don't need to do that. What you do need to do is talk to your tax advisor, because I want you to understand what it looks like from a tax liability perspective. So let's take a simple example of $100,000. If you have a traditional IRA of $100,000 and you convert it to Roth and you do the whole thing, that $100,000 is added to your income for that tax year, and you're going to pay taxes according to whatever your tax rate is. That's why I want you to talk to your tax advisor. Okay, so the idea here is to do a Roth conversion, whether it's cash or an asset. I'll talk more about assets here momentarily, all the way up to the point where you're like $1 underneath the next highest tax bracket. Okay. And there's some nasty jumps, right? Like I think it's 32 to 37, for example, at the highest tax rate. Don't want you to jump to the 37 because you converted or you added $1 too much to your earned income for the year. Okay, so talk to your tax advisor about that. The reason it's important to know that the deadline for tax year is December 31st is because conversions are accounted for in an entire year. Whether you do it in February or December, it still counts for that tax year. So sometimes a strategy is, if you wanted to break up the $100,000 into two separate tax years, the strategy is to convert $50,000 on December 20th and another $50,000 on January 2nd. That way it's $50,000 of earned income added to your earned income for 2025 and $50,000 added to your earned income for 2026. Okay. And you can do this strategy with an asset, which I'll explain, or with just simple cash inside of an IRA or even a solo 401k. All right. Now, incidentally, check with your tax advisor on this because just to clarify, but my understanding is that the tax rates were extended indefinitely as part of the Big Beautiful Bill. So that keeps the tax rates at what they are, which 37% is the highest. Prior to that 2018 bill, it was higher than that. And so I don't know if it's going to be, it's permanently, right? So things can change, but they're no longer temporary, they're permanent. So anyway, consider this when you're thinking about doing these Roth conversions, because down the road, the taxes may be higher is what I'm trying to say. All right. But again, check with your tax advisor. So here's the methods. Okay. I talked about the first part already, is converting over 2 years. 100,000 is just an example. It could be whatever dollar amount you want. You can convert deal specific. So what that means is I have oftentimes when people come to us, we obviously here at Sense Financial, we specialize in self-directed retirement accounts, specifically solo 401k and checkbook IRA. And oftentimes people come to us and they say, hey, I'm looking at a specific investment. It could be a syndication, it could be just a rental property, private lending, whatever it is, but it's very specific. I've got 123 Main Street in my crosshairs, and I want to buy it with my IRA. Okay, that's what I mean by this. But I want to do it in Roth. Okay, so the question is, when do you do the conversion? In this example, the conversion would be done before setting up the self-directed Roth IRA. Convert at the plan where it's at, right? Let's call it a traditional IRA at Vanguard. Open up a second Roth IRA at Vanguard. Do the conversion at Vanguard. It's free, other than, the income tax that you have to deal with. And then set up the self-directed Roth IRA and then move the funds from Vanguard as a Roth IRA into the self-directed Roth IRA. And now you're converting deal specific because your plan is to immediately take that self-directed Roth IRA those funds, and invest in the specific deal. Okay, so that's what I mean by convert deal specific. Then there's the in-kind asset conversion. And I have some examples of this. The in-kind asset conversion is where you make an investment using traditional funds, then you convert the asset, quote unquote, in kind to Roth, usually at a significant discount. Now, this is easier inside of a solo 401k than it is an IRA because a solo 401k has both Roth and traditional pre-tax built into the same plan, whereas an IRA is either traditional or it's Roth, but it's not both. Okay, so in kind usually applies to alternative assets, non-public assets, not stocks, bonds, mutual funds, and ETFs, real estate, private loans, just to name a couple common examples, right? So what you do, and I have some real examples of this momentarily, but what you do is you convert that asset after you get a valuation of it, you convert it from traditional to Roth, okay? Now, all the returns, the principal investment, the asset itself is all in this Roth bucket, right? So the beauty of this, and a lot of people do this from a strategy perspective, the beauty of this is, yes, Ven, I will answer that question. I see your question. The beauty of this is you can, let's say you want to, okay, let me back up. I was talking to somebody this morning and this gentleman was saying, okay, I want to invest in real estate in overseas oh gosh, what did he say? I think he said Costa Rica or Puerto Rico. I can't remember. Those two I get confused sometimes, but let's call it Costa Rica. You can do that. There's no rule that says you can't invest in real estate out of the US. You absolutely can. Okay, IRA, it doesn't matter. We can't advise on that necessarily because it's real estate out of the country and we don't give financial advice anyway. So talk to a CPA on both sides of the ocean. But my point is, usually when people say that, it's because they want to have personal use of the property. And unfortunately, while the 401k or the IRA owns the property, you are a disqualified party to the plan, and so is your immediate family. So you cannot have personal use of it. However, what people often do is they say, okay, that's fine. I'll own it in my IRA for 20 years, whatever it is. And then when I get to 59 and a half, I'll distribute it to myself. Because here's the thing, just like doing a Roth conversion of an asset, you can actually distribute an asset to yourself as well. Even whether it's an RMD, a required minimum distribution, or just a regular distribution, you can distribute the asset to yourself once you're 59 and a half without taxes or penalties. And here's the thing, I shouldn't say without taxes, because if it's traditional, it is going to be taxes. There are going to be taxes. If it's Roth, you could distribute that property to yourself completely tax-free. As long as you've had that for at least 5 years and you're over 59 and a half, and you can literally get a property, a piece of real estate completely tax-free. So that's one method that you can use. Make the contribution or make the investment now, hold it in your Roth fund till you turn 59 and a half, and then you can distribute it to yourself tax-free. So, hopefully that makes sense. Now, Ven, I will stop for a moment and explain what I meant by that. Ven is asking, can you explain what it means when you say solo 401k has both IRA and Roth built in? If I said IRA, I misspoke. It's not an IRA, it's a 401k. what I meant to say, if I didn't say it clearly, is that a solo 401k has a traditional bucket and it has a Roth bucket. It's not an IRA, it's a 401k. Two separate types of plans, but the funds kind of operate the same when it comes to contributions and distributions. So that's what I meant by that, okay? Whereas an IRA is either a traditional IRA or it's a Roth IRA, but it's not both, okay? So that's what I meant by that. Hopefully then that answers your question, all right? Oh, let me move on here. All right, so here's an example, okay? This is an example of an in-kind Roth conversion. All right, Frank here has a solo 401k. He is a client of ours. Now, Frank put $300,000 into his solo 401k by rolling money in, and he invested that into a triple net lease and a strip mall, okay? This is a syndication. The overall purchase price was $3.2 million. His 401k's investment was $300,000. Now it's a triple net lease, which just means, that's what the 3x net means, just means that the tenants are paying for the taxes and the common area maintenance and all that good stuff. All right. Which is a great investment, by the way. We should all strive to have triple net leases as investments, but the total purchase price, 3.2, his purchase price or his investment was 300. When you do an in-kind conversion, you have to have a dollar amount to convert, and it has to be provided by a third party. You can't just say, okay, my $300,000 investment is worth $10,000 and that's the value. So I'm going to convert this $300,000 investment at a taxable amount of $10,000 and now the entire thing is Roth. That doesn't work. You have to get a third party valuation. And this third party should be a licensed company that does appraisals for this sort of thing, okay? For Roth conversions. So when Frank did this Roth conversion valuation, the fair market value came in at $200,000 or 33% off, which is amazing. He got a 33% discount on this conversion. And the value was based on being non-marketable, right? Which basically means it's illiquid. He can't turn that investment into cash very easily, so it's not marketable. No one's going to buy that from him. He had a minority interest, right? We already said 300,000 versus 3.2 overall. And he has a lack of control because it's inside of a retirement account. And all these factors will allow the value to come in at a discounted rate. Okay. Now, if he converted the cash of 300,000, the entire dollar amount of 300,000 is going to be added to his earned income for the conversion. But because it was an asset and all these factors I just mentioned, it came in at a discount. Super powerful. Ven is asking, can the syndicator provide the fair market value? Ven, that is a great question, probably for a CPA. I would venture to say that that does not meet the qualification of a third party valuation. So I would say no, probably not a good idea. Okay. But feel free to correct me on that down the road if you find out otherwise. Yeah, no problem. All right, here's example number 2. This is a checkbook IRA investment. Okay. Jane invested in a second mortgage, a second trust deed, $50,000. And the whole point of this was to take this investment and actually convert it to Roth. All right. Now, same examples, not marketable. No one's going to buy that investment from her. I mean, they could, but it's not easily done. And she has, in this case, she didn't have a minority interest because she owned the entire second trust deed. But this could work if you had what's called like a fractionalized investment with a trust deed or with a mortgage, where you had 50 and somebody else put in 50 and somebody else put in 100. You could have a minority interest, or, maybe even 49,000 and then there's a 50,000 investment and 100,000. So you are the minority, but nevertheless, still have the lack of control. And so this valuation came in at $21,000, 42% off, even better. Now I want to back up real quick to Frank, because there's a factor here that I didn't mention. And this would work, theoretically for either one. But Frank is a real estate professional. Okay. I realize not everybody listening to this and not all of our clients are real estate professionals. And what I mean by that is they're claiming real estate professional status, which opens up bonus depreciation and, you being able to report or take advantage of losses on your taxes, on your taxable income or against your taxable income that you wouldn't otherwise be able to do. Okay. Check with your tax advisor if you can qualify for real estate professional. Frank can. He's spending at least 750 hours a year in real estate professional activities. And he's got personal investments that he was able to have enough losses in, probably depreciation on real estate, to offset this $200,000. So actually his income was not $200,000 because he had so many losses to report against this. So it was even better than it looks like on this. And by the way, a factor I also forgot to mention, this is a real client, by the way, that's not his picture and his name's not Frank, but Frank was able to, by this one move, he was able to move up his retirement age from closer to 60 to like 52. Super powerful, because now he's going to be able to take these. I'll explain this in a couple slides, and I don't want to confuse people, but he's going to be able to take distributions from this Roth account before 59 and a half, tax free and penalty free. And I'll explain more on that in a moment, but super powerful. And I love the story because we were a part in reducing somebody's retirement age by almost 10 years, which is awesome. All right. Okay. So here's the distribution rules. We all probably on this call know that the qualified retirement age is 59 and a half. Okay. That means that just as a general rule, you can't take distributions from your IRAs or 401ks until you're 59 and a half. That should not say 59.9, by the way, 59 and a half without taxes or penalties. Okay. Now there's some exceptions with Roth, and I want to talk about that. So first of all, there's this thing with Roth called the 5-year rule. And if you have had a Roth, and there's different components to this, but if you've had a Roth IRA, okay, for at least 5 years and you put in, then you can withdraw from any Roth account. Okay. So I could have a Roth IRA over at Vanguard for 5 years, and I could have a Roth 401k with my solo 401k for like 6 months. I can take a distribution from the principal without taxes or penalties because I've had Roth for at least 5 years. Okay. Now the seasoning starts January 1st, the year of your first Roth contribution. Okay. That's what I was just talking about. Now, once the seasoning is complete and you've reached 59 and a half, I don't know why I typed a 9 on both of those. My apologies. All distributions are tax and penalty free. Okay. But the key is 59 and a half. Now, there are ways to distribute funds prior to 59 and a half. And this is where Frank's example came in and why he's able to retire, if he wants, much earlier than 59 and a half. Okay, so there's different types of funds or money inside the Roth. There's contributions. Okay, so let's say $100,000 Roth balance, taxpayer's 49 years old, and the Roth contributions and the converted amounts have seasoned for at least 5 years. He can take out the money, again, not 59 and a half yet. He can take out those contributions without taxes or penalties. Okay, so this is like an emergency savings fund, or you can use it for whatever you want. All right. That's contributions. Then there's conversions, and there's regular conversions, but then there's also non-deductible traditional IRA contributions, which have been converted to Roth. Those two are treated separately. So those are like your backdoor Roth contributions. Backdoor Roth contributions. So you make a non-deductible traditional IRA contribution, and then you convert it to Roth. Those two are treated differently in this case, okay? Regular conversions are what I was just talking about, whether it's cash being converted from traditional to Roth or an actual asset like Frank's example or Jane's example being converted from traditional to Roth, all right? As long as it's seasoned for at least 5 years, you've already paid taxes on it, then you can take the money out prior to age 59 and a half. You wouldn't take out the non-deductible first. You would start with the regular and then move to the non-deductible. If you needed to exhaust all the regular, you would do that first. Okay. So this is kind of the order of things. And then you have the earnings. Well, the earnings are pretty much stuck. Okay. So you haven't paid taxes on the earnings. So you got to be 59 and a half and at least 5 years before you can touch the earnings. So can you distribute the earnings prior to 59 and a half? No, unless you meet some certain hardship, higher education expenses, or other 2T type things, items to talk to your tax advisor about if you really got to go down that path. Okay. So it grows tax-free, but you don't touch the money until 59 and a half. All right. And furthermore, on this, when it comes to taking a distribution from the retirement account, I would caution you to only do it if you really, really need to do it, because the whole point of a retirement account is to have it grow. I'm not talking about at retirement. I'm talking about prior to that necessity for kind of living on it, right? Again, it can be an emergency fund, if you will, and growing tax-free, because you can take those contributions out since you've already paid taxes on the contributions and the conversions, as long as you've had them for at least 5 years. But ideally, you don't do that. You let it grow. Now, it is important to note, I don't have this here as a bullet point. It is important to note that each contribution has its own 5-year rule. Okay. So while straight contributions are all in the same 5-year bucket, like my second bullet point there, as the 5 years from the year of your very first Roth contribution, all the contributions are in that bucket. The conversions each have their own 5-year rule. So for example, if I did a Roth conversion today, whether it's cash or an asset, the 5-year clock for that specific conversion, let's say it's $50,000, starts on January 1st of 2025. If I do another $50,000 conversion in, June of 2020, 5-year clock on that Roth conversion starts on January 1st of 2026. So each conversion has their own 5-year clock. All right. So it's important, if you're going to do 5 conversions and not touch them for 15, 20 years or whatever, it doesn't really matter. But if you're going to touch them, you got to be able to understand, okay, which one was 5 years, which one was done in which tax year. All right. So from an accounting perspective, it can get a little bit tricky, but just keep an accurate spreadsheet, accurate records. Again, consult with your tax advisor on all of this. I just want to be clear about that. All right. I'll give time for more questions, but if you would like to jump on a call and talk about your situation, whether you're a client of ours or not, whether you are considering self-directing, either using a solo 401k or a checkbook IRA, I'd love to talk to you. Totally pro bono. Just grab a spot at SenseFinancial.com/consultation. When you book that call, you will automatically receive about a 19-minute video that I have already created discussing the mechanics of the checkbook IRA versus the solo 401k, which is obviously good to watch before we get on a call because it'll make our consultation that much more productive. But I encourage you to do that. Also, we have tons of resources on our website, SenseFinancial.com, that you can check out. But that concludes the session for today, outside of any questions that anybody has that I would love to answer. So Ven, we've already answered some of yours. Thank you for putting them in there. But if anybody has anything else, now's the time. Go ahead and type them into the chat, and we'll give it just a few minutes here. And then we'll just wrap it up if nobody has anything else. All right, Leah, they're quiet out there today.
Yes, they are. But
that's
again,
all right, though.
Thank you so much to everyone who had joined in. And thank you, Ben, for typing in your questions. It was really nice to meet everyone today. And thank you, Deb. Thank you. She mentioned that it was very interesting. So that's really
Deb,
good to hear.
Yep,
all
appreciate
right.
it, Deb.
Looks like we'll be wrapping it up here. Again, thank you so much, everyone, for joining in today, and we'll see you in the next webinar. Have a great one.
Hold on. MK has a question, maybe. Converting within a solo 401k. MK, what? Be more specific. What are you asking? Or is you just making a comment? Is it as easy as moving funds from taxable part of 401k to Roth part? Is it as easy? Well, it's easier inside of a solo 401k than it is an IRA because, as I mentioned, the solo 401k has a Roth component and a traditional component in the same plan. So I should have talked about this, actually. I'm glad you brought this up. So if you convert an asset in kind, like Frank's example, okay, let me go back to that. Okay, Frank's example. So his 401k is an investor in this triple net lease. Love it. And the name, let's call the name of his solo 401k, Frank 401k plan. So that's what's on all the documents. That's what's on title to the real estate, everything, right? He's just signing on behalf of it. That's what checkbook control is. Now, with the solo 401k, the owner doesn't change. So even though it goes from the traditional bucket to the Roth bucket, the owner is still the same 401k plan. There's no need to go through the hassle of changing title. However, you do have to keep track of it, of course. So now the income is going into the Roth component, which might just mean you have a second checking account, right? Traditional checking account, Roth checking account, just to keep the funds separate from a cash perspective. It's not difficult. However, if it's an IRA, a checkbook IRA, now title's going to change, most likely. There is a way around that, but title's going to change most likely because you're going to have your traditional IRA, which requires the use of a special purpose LLC. Let's call it Frank LLC. Frank LLC is the owner of the traditional IRA and that asset. Now, when he does the conversion, it has to go into a Roth IRA. So there's another LLC. So this would be like Frank Real Estate LLC. So now the title has to change on that asset because now it's moving into a different account, a different IRA completely. The exception would be as if you took all the assets in the traditional self-directed IRA and you converted the whole thing to Roth, then you could keep the same IRA and just kind of switch it to Roth without having a secondary IRA. But most people don't do that because they don't want to take on that tax liability depending on the numbers. But with the solo 401k, it's much simpler. So does that make sense, MK? Does that answer your question? You got it. All right. Hey, thank you so much, everybody. Leah, really appreciate it. Thank you, everybody who attended. Please grab a spot on my calendar if you want to have a conversation. Happy to.